trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon. Once again, Market Rebels. And Stu, it is time for Coach's Corner again. Seems like it rolls around awfully quickly.
I would say it about once a week.
It does, but it seems like it's about 5 times a week. It just seems to come so quickly. But we enjoy doing this. We enjoy helping people with some tips, a lot of things that people don't realize or probably won't hear somewhere else. And today we've got a special one. You're going to like this one. So here we go. Let's start off with our Chalk Talk, our intriguing question for everyone. If you're new to us, first of all, it's great having you here, but something to think about, and we'll come back at the end of the webinar here and we'll answer it. So what happens to a risk if you try to hedge it? A little bit of a vague question, but what are some repercussions there if you try to hedge a risk? So in other words, you might say, let me hedge a long call by legging into a vertical, or let me roll an option so I can get some cash off the table. Let me sell a call so I can reduce the downside for a covered call. Those are all ways that traders usually talk about hedging a risk, and there's something else that absolutely has to happen when you do some type of a hedge. Actually, when you do any kind of a move, any kind of a closing a trade, entering a trade, this is going to be true, but it's particularly relevant when people think that they're hedging. So what is the answer here? What's our topic? Risk migrates. This is something that, yeah, no, you know this one all too well, but it's something that a lot of traders aren't familiar with. It's sometimes called a conservation law in finance. So for any of the physicists out there, we have lots of conservation laws and conservation of angular momentum, for example, and things like that, it can't just vanish. It has to go somewhere. And the same is true with risk in the markets. The risk lives in the market, and so if you do a change, open, close, hedge, roll, morph, whatever the case may be, the risk has to get pushed somewhere else.
You mean it doesn't go away?
It does not go away. That is correct.
It goes somewhere.
It has to go somewhere. And unfortunately, a lot of people think, oh, I've hedged it, so now I have no risk, or I've reduced my risk. And what we're going to show is that's not true. You have changed your risk, and you might unknowingly have made it worse. Pretty wild. So let's talk about that.
So I think the assumption here for most people is that when they do something, they are taking whatever risk they think they have,
right,
and they are pushing it off out of their equation.
That's exactly right. And
what However, they don't realize in reality, they may actually be, well, in reality, what they could be doing is not only retaining said risk, but the risk is kind of morphing into another plateau or another avenue of
Another
risk,
dimension.
another
That's exactly
dimension,
right.
great word, which they may not be aware of.
Yeah, it has to go somewhere. And so kind of an analogy that I used in a podcast was, I think it was called Check the Closet. It was on this topic and saying that you get this call, you've got guests coming over unexpectedly. What do? Clear off the counters, clear off the, sweep everything. So everything looks great until you open the closet and realize everything got shoved in there. It can't just disappear. It has to go somewhere. And that's the thing is that traders think, and in fact, they might even be mitigating risk or eliminating it, but they don't realize they have also moved it somewhere else. That's really the key topic. So risk lives in the market, not in the trade. Markets are just, we all know that how they can be crazy and chaotic, and that's where the risk lives. The options allow us to slice and dice it into different dimensions, but the risk lives in the market. So another analogy that I've used is think of it like driving down a highway. The risk is on the highway, not what color car you have, or now that I've successfully driven 5 miles, let me change from the red car to the blue one, and now I've hedged my risk. No, you're still in the uh, same traffic. That's where the risk is, and that's how it is with the markets. So that's what this concept is known in finance as risk migration. So any trade you make to reduce or eliminate risk migrates, meaning it gets shoved somewhere else. That doesn't make it bad. What makes it bad is if you think you have only reduced risk instead of altered risk.
Yeah,
That's the
what
key
makes it
distinction.
bad is that you think it's not there anymore. That's what makes it
Or that there's no risk there anymore, that
right.
things are
Or you
now
just
just
went
safer.
from a high probability concern to a low probability concern.
That might be one. Or you've concentrated the risk somewhere, or you've sold off the tail. There's all kinds of ways that this can appear. So again, you can't eliminate it, only change where risk lives. So closing a position, I like to talk about this because some people say, well, wait a minute, that's not true. What if you have a stock position or a long call and you close it? You've now completely eliminated risk. Not true. So there's the question that people ask. Doesn't that eliminate all kinds of risk? Well, you may have closed a positive EV trade, meaning that you were on something that actually had a positive edge and you just shut it down. Now that's not really a risk, but it's an opportunity cost.
Opportunity.
You left something that would have been a good trade. And you might say, all right, well, that's not really a huge risk, but I've got cash. Now we're talking. The cash has to go somewhere. If you put it into new trades, they might be worse. And I know this is where traders say, oh, I've closed it. Let me move into something else, as if that now makes it less risky. That is not true. You've now migrated it into a different trade. But here's where it can get even trickier. I'm not going to put it back into the market or into options. I'm going to put it into bonds. All right, now you've got interest rate, inflation risk, dividend reinvestment risk, all of these different risks in bonds. The risk now went into these. What we might also have unintentionally created portfolio concentration risk. So these positions that you closed thinking that you were reducing the risk left you with a bunch of chip stocks, and you don't realize it, but now your portfolio is concentrated, and you've completely chopped off the diversification. That's a risk too. The point is, it has to go somewhere. So in these examples, you might migrate from what we call local volatility, the risk of that actual trade, into a structural return risk, meaning some of these examples right here. You've now changed the structure of the returns of the entire portfolio, but you don't see it because you say, well, I had that long call there, Stu, had a lot of money into it, I've made some money, let me close it and move on, and I've now mitigated risk. No, you did not. You've migrated it. And that becomes a very hard thing to see. But hopefully, just at least understanding the concept helps people to think, man, maybe I should look somewhere where this might have gone. So we're going to look at an example here. Before we do, you know where we're going with this. Typical reminder, marketrebellion.com/get started. All kinds of great articles, videos, lots of stuff in there. on topics just like this to help you build a very firm foundation with options. And that's what we're all about. So, Stu, and actually this topic came about because you and I were just talking about this the other day for a different reason. But as a simple example, let's do a vertical spread. Once you see it here, you're going to have it for butterflies and condors because you'll recognize those are just two vertical spreads facing each other. But the concept that we're trying to show is that the risk has to go somewhere. So let's take a vertical spread. And to make the demonstration even more dramatic, we're going to use the stock at 500. So we get some expensive options in terms of dollars. We're going to pump up the volatility to 40%. And it's a pricing model says that the $500 call 30 days is worth 23 bucks. So you would have to spend 23 bucks, 2,300 bucks.
Yeah. Yep.
And you might say, you know what? For whatever reason, I don't want to put that much into it. Even though it might be relatively cheap, for some reason, we just don't want to put that much exposure.
Yeah. Could be a low
fine.
IV rank. It could be, it just might be, it might just look like it's cheap, relative to the expectation that you are seeing.
Right. So now we look and we see that the 505 call is trading for 20. So we could sell that for 20. So we're spending 23, we're collecting 20, and that gives us a net debit of 3. This is the primary reason. It's not really the true structural reason, but it's a primary reason for a lot of retail traders why they do a vertical spread, because they want to reduce the cost of the long.
Hear it all day. Reduce my cost basis. Reduce my cost basis.
Reduce my cost basis, right.
Let me sell these calls to reduce my cost basis.
Exactly. So right now, this is the risk graph we have. We have a bend at 500. That's our long. We have a bend at 505. On a net basis, we have $3 into it, which is right there, line up at 3. So that's telling us that no matter how low the stock price goes, worse it happens is we end up here. Why? Because below 500, both options expire worthless.
Yeah.
And we're out to $3. On the high side, best we can do is 2. Why is that? Well, we have a $5 difference. I have the right to pay 500, the obligation to sell for 505. That is a $5 benefit to us, period. No matter how high the stock price goes, that's it, and that's why we flatten out here. So if we paid 3 and we can ultimately sell this spread for 5, the best, this is a profit, remember, the best we can make is 2. Now, what's our break even right here? Kind of looks somewhere between 500 and 505. It's where our risk graph crosses 0. We have no gain or loss, and it turns out to be at 503. A couple of ways we can do this. We'll look at it the way that most people would. We'll look at it synthetically. If we buy the 500 call, we've paid $3 total for this position. And if the stock is 503, this one goes out worthless. We can sell the call for how much? 3. We paid 3, broke even. But we can also look at it synthetically. This would be the same thing as a put spread, credit spread. Let's look at it from this direction. What if we sold the 505 put, bought the 500 put for 2? Now we work this way. We can afford to have the stock fall $2 below 505, and look where we land. Right back to 503. We could also say that would be a liability. We'd have the obligation to buy at 505, the right to sell at 100, which is a $5 loss, for which we were paid $2, and that would leave us with a $3 loss. All lines up.
I want to do that
one.
It
all works out, isn't it?
I want to do the credit spread because that's paying me money.
Because it's paying me money. No, it's not. Exactly. We hear that all the time. That's a form of risk right there, is just not understanding what you're looking at.
It's a huge form of risk.
Yep. So now, according to a pricing model, let's say 12 days later, our stock is up here at 508. And people go, oh man, it's breaking out. I'm getting killed. We hear that a lot. No, you're not. You're at max gain. It's an opportunity loss, but they still want to buy this back. So we look at this and we say that the 505 call is now, we collected 20 when we sold it, but right now it's trading for 19. Okay, 12 days later, stock is higher, but it's also time has gone by. And this is where traders go, you know what, Stu? I collected 20, I can spend 19, and I've got a gain. So I can close this one out for a gain, and I still have this long call down here kind of for free. Or they might do this. I have a credit of 1, and I can now offset my cost basis over here. I'm into this long spread for 2. I mean, this long 500 call for 2. No, you're not. Not even close. But that's the way that a lot of people look at this. They say that was my initial cost, and I now just got a credit. And I profited here. I've banked some profits, and now I've got this call option for $2. Well, here's what you have to learn to do is to track the cash flows. When you bought the 500 call, you spent 23, take a piece of paper, write minus 23 for cash going out. You sold the 505, you collected 20, write plus 20, but then you spent 19. So yes, it's a net dollar right here, but that's looking at the price between where you sold it and bought it. You still spent 19. So what's the total here? 22. That's very different from 3. So what happens is that you have the long call at 500, that's your bend, but you're into it for 22. That's about 3 times your original. Oh, I'm sorry, we were into it for 3, weren't we?
$3, yeah.
We're into it for 7 times now.
Almost 8, yeah, 7, 8, yeah.
So it's about 7 or 8 times now more money. And if you did this 10 times or 20 times, thinking it's only 3, now suddenly it's a whole lot more. What happened to our break even up here?
Yeah, that's the thing. Bill, can you go back 2 slides just for a moment? So check this out. No, you can put that back up there. That was fine. Yeah, okay. So you're gonna look at this and you're gonna say, well, I sold them for 20 and I'm paying 19 and I made $1. No kidding. Okay, very good. What you're what and then the next slide we were talking about how that break even went from 503 to 22. Yeah, there it is, 522. See, that's a huge
That's 3
piece of
points, almost 4% higher. Once again, people say, well, that's not much. True, but it's all relative compared to what? If you look at how far stocks move in a year, a lot of stocks will take 6 months to move that. Now, I know we've got leverage in the options, but the point is that this is a stock percentage right there. We need that to move in the next, what I say it was 12 days later, so we got 18 days to go.
Yeah, it's like at 505 you're making money, and at 520, had you done that adjustment, you're not.
You're not. That's correct. So now,
and this is a huge danger. We get this all the time, don't we, in Q&A? Should I buy back my short? We had somebody recently who, while we're on this topic here, wanted to know, they did a long vertical call spread. The stock was going down, and the question posed was, should I sell my long and keep my short?
Keep the shorts, right?
Should I get rid of the one that's hurting me?
Get rid of the one that's hurting me, or close the ones that have a credit like we did here, where I have
same idea.
And they don't realize the risk has to go somewhere. They don't realize that all got moved, that $19 cash flow that you spent all migrated into your cost basis on the long.
And what got me was, okay, I get it. You don't really understand. You don't really get the numbers. That takes time. But the part that gets me is that people have a way of putting themselves into these situations.
Yep.
And then it blows up on them.
Scratching their head going, how'd this happen?
And they're like, what happened? Oh my God, it's the market makers, it's the specialists, it's the stock, it's the market. The market turned on me. It's not the same market.
Right. I only had $3 into it. How come I'm taking such a much bigger loss? Or I only had $2. I had 3. I got $1 credit. I only have $2 into it. How am I down so much?
Or you're getting tapped on the shoulder by the broker saying, you got to pony up some more money.
Yep,
right? Or
that
you don't have
happens a
the
lot.
cash available. So you can't sweep cash, so you have to sell something else that's maybe doing pretty well for you,
Might be there's another form of a
right? And
risk.
there's
There
an
you go.
opportunity risk on that
Yep.
end to fund something that is really kind of moronic.
And
To
actually,
put it
that's a very good
well.
point because we've talked about this from a behavioral finance standpoint. If people have to sell something, what are they more likely to sell? Things that are winners or losers? More likely to sell winners
They're gonna
because
they're gonna look for the cash.
they're going to look for the
Yeah,
cash and they say, but
they
I
don't
don't
want
want
to
to I don't want to sell this
feign
because
defeat, right? I mean, hey, I'm going to sell a loser? No way. I'm in it to win it. I'm keeping it.
right, I'm going to keep it. But there's another form of risk migration. So you're selling something that's performing well, and that doesn't necessarily mean it will continue. But what if it did? You're choosing to hold something that is performing poorly. That's the portfolio migration that we talked about. And now you're having to meet a maintenance call. But the point is, the risk has to get moved somewhere. It does not get destroyed. And that's what we call in finance risk migration. So probably the biggest thing to take from this, no matter what you're doing, opening, closing, hedging, rolling, legging into something, closing part of it, it doesn't matter. It is a trade. And when you do that, especially if you're looking at it from a risk perspective and saying, I'm trying to reduce my risk, that's okay. But then say, where did the risk go? You know, another one, Stu, we've talked about like when people roll calls, they might go from the 505, the 500 call, let's say if they started out with this, stocks up here, maybe where did we say it was 508, and they say, let me roll to the 510 call and I'll get all of this cash off. And now
Which they will.
I'm in
They'll
a
get
better
cash off.
position. You will. But what happened? Now all of your risk is concentrated here at the 510 strike. If it dips
Yeah.
below there at expiration, you lose everything. Whereas here, that's not true.
Yeah, it's a different kind of money. There's
It's a
extrinsic
different
money
kind
and
of
there's
money.
intrinsic money, and they are on
Yep.
opposite sides of the aisle.
Yep.
Cash is cash and extrinsic is not. It's fluff. It's
Exactly.
juice. It gets measured. It's implied volatility. It's about the future.
Right. So that's really the point of this one is not so much all of the places that it can hide. We
Yeah,
just
right.
want you to understand that the risk is always in the market. And if you do a trade, anything, you are again sweeping, cleaning up the house and you're sweeping it into a closet or under the rug or something, it has to go somewhere. It can't be destroyed. It has to go somewhere to conservation law. And the question is, where did it go? And that's really the question we want you to at least hit the brakes, yellow light, like we talked about in Miami, and say, well, hold on a second. Where did the risk increase to, or at least change? And if you can't answer that, you might want to hit the brakes. And
Yellow
for all
light.
and for all of our people in Q&A, those are great questions to bring for Q&A. Just ask, I did this trade. Where did the risk migrate to? And once you start to see that, you'll be able to figure it out. But for right now, it's an important starting point to realize you did not get rid of risk. You might have reduced or eliminated one type of risk, but it got shoved over into a different closet somewhere. And that's the important thing that we want you to get from that. So that's risk migration. So let's go back to our chalk talk. I think everybody's got the answer now. What happens, and that should be to a risk, if you try to hedge it? Does it go away? Does it get eliminated? Nope, it migrates. It went
Changes.
somewhere. Promise you, it went somewhere. So with that, that was a little bit shorter for us here, but I think it's a very powerful concept that a lot of people don't hear about because we always hear, oh, roll the option, get the cash off. I got a credit. Oh, I'm into a risk-free trade. I'm into house money, as if they have no risk. But you have to say it is there somewhere. Even getting into that risk-free position, you have probably concentrated the risk very close to the current stock price. You now have a lot of gamma risk, a lot of vega risk that you didn't have before. There's some type of risk that got altered or increased. And
And,
that's what we
and
want people to think about.
and that's a huge red flag if you're not really seeing that, especially in
Oh, yeah.
high vol stocks,
Yeah, oh, yeah.
especially in high dollar high vol stocks. things
Times
like
10.
Tesla, for example, high dollar, high vol stock. You get a winner and you go to roll it, and you're looking down the line, and you're going to roll it to a strike that that at the money strike or slightly out of the money, and it's like, whoa, you're looking at these major dollars,
Yep.
and you're thinking, well, I don't really want to put that into it. I want to walk away with money in my pocket here. I mean, that's the name of the game, right? So they start chopping down the strikes to find that option that kind of fits the bill from the money perspective. And now you've severely changed your risk profile by going further out of the money.
Yep.
And there's all kinds of crazy stuff that's going on behind the scenes there. And we just want you to understand that there's something there, and to stop, think, just be logical about it. Put the brakes on and just kind of think about what it is that's really happening. Follow the money, follow the different risks that are inherent in these kind of different trades, and that's it. So
Yeah. And as we also talked about in Miami, that anytime you receive a credit, another type of risk, people think that they're reducing it. But what's the only reason that a market pays you a credit? You've either accepted a risk or you've sold off probability space. So you've probably concentrated it somewhere or just increased the risk. So there's lots of different types of red flags, things we love to talk about in Q&A. But again, for right now, we hope that gives you some very good things to think about. One good thing to think about, and that is that risk migrates, it lives in the market. You cannot eliminate it. You can only shove it into a different corner. And so with that, we want to thank all of you for being here, Stu. That was fun.
yeah.
And we will see all of you next Thursday for Coach's Corner. We'll see you then.